The total assets under management or the total assets held by the mutual fund industry have crossed the 50 lakh crore rupee mark. This clearly speaks of the growing trust investors are reposing in mutual funds. Mutual funds provide investors with the opportunity to invest in different asset classes. Mutual fund schemes invest in various assets ranging from equity to debt, gold, and silver. Additionally, there are specific focused schemes catering to goals like retirement planning and children's education. Moreover, if you want to invest in foreign markets, you can also do so through international mutual funds. Watch this video to understand in 9 simple points what international mutual funds are and how they work. First, what are international mutual funds? International funds are mutual funds through which investors can invest in companies of other countries. This means that an investor residing in India can invest in the shares of companies in the USA or the UK, all by means of international funds. These funds invest in listed shares and debt securities in the foreign markets. In addition to this, you can also invest in exchange-traded funds or ETFs, which invest in listed shares on foreign stock exchanges. These are known as overseas ETFs. There is also an overseas category of funds, that is FOF, where a minimum of 95% of assets are invested in foreign funds. Second, why should you include international funds in your portfolio? Well, one way for an investor to reduce risk in their investments is to diversify their portfolio. For this, investors invest in different types of funds. There may be a situation where the domestic economy is not doing all that great, but a foreign economy is in a far better position. In such cases, investors can benefit from investing in international funds. This also helps them in portfolio diversification. Third, how does investment work? Well, investing in international mutual funds is not very different from purchasing units of domestic mutual funds. You invest in rupees and in return receive units of international funds. The scheme you invest in will further invest in listed shares in foreign currency. This allows you to participate in the development of a foreign economy as well. For investors in India, there are various options available in international funds based on countries, themes, sectors, and technology. Fourth, what do RBI regulations say about international funds? As per RBI regulations, domestic mutual funds can invest up to $7 billion in foreign stocks. In addition to this, they can also invest up to $1 billion in ETFs. Since this limit of $1 billion investment is nearing its end, SEBI has instructed mutual fund industry to stop new subscription in foreign ETFs effective 1st April 2024. Fifth, why was there a need to set a limit? By setting a limit on investments in international funds, RBI aims to maintain the balance of payment equilibrium. The Reserve Bank of India is trying to limit the outflow of foreign currency for the stability of the Indian currency. Therefore, even international mutual fund schemes will have to limit their investments. However, until SEBI issues separate guidelines, investment in foreign securities, excluding foreign ETFs, may continue. Sixth, what are the experts saying? Well, according to Hemant Rustagi, CEO of Wise Invest, there are still opportunities for investors to invest in foreign stocks through funds. Those who have invested in international funds within the specified limit and in markets with good prospects should continue with their investment. Seventh, what about returns? Talking about returns, until 5th April 2024, foreign ETFs have given an average return of 38.8%, 25.2% and 16.4% over a 1, 3 and 5-year period respectively. During the same period, the return on international funds was 24.8%, 5.8% and 10.3% respectively. 8th, what about the taxes on your earnings? When it comes to taxes, it is essential to compare investments in equity. Funds that have invested less than 35% of their assets in equity will be taxed on the earnings generated by the investor based on their applicable tax slab. If the fund has invested 35% or more in equity, it will be considered an equity-oriented fund for taxation purposes. A flat tax rate of 10% will be applied to earnings from equity. However, remember that a profit of up to 1 lakh rupees in one financial year is tax-free. 9th, how much is the risk involved? Well, there is always a risk in investing in equity worldwide. Despite this, investors in international mutual funds should be cautious about the risks associated with the economy, politics, and tax regulations of that country. Additionally, since investments are made in the currency of that country, investors also bear the risk associated with currency fluctuation. What's Money9's advice? According to reports, many mutual fund companies have appealed to RBI to increase the overseas investment limit. Money9 advises making investment decisions based on your portfolio allocation and avoiding any hasty investments.